You guys. Hey, what's up, everybody? It's another beautiful day in Florida on Delray Beach, and Mr. Topstep's got a pretty good thing going here today. One of the things that we think is important about trading is not trying to overdo it. We really do. Meaning trying to over push a product or being online doing webinars, all that. And if you've got a specific product, that's one thing. You're out marketing yourself, and that's great. But one of the things that I've found is that when I'm trading and I'm doing a lot of the writing and I'm doing webinars, I lose focus of what I'm, of the markets and stuff like that. Today we have Peter Davies from Jigsaw, great guy, lives in Thailand. We have David Dube, who we have been working with for many years. Very, very smart guy, former Morgan Stanley trader. And last year we have Gagan Daphu from London, who will be talking about Tesseract and the system that I actually am using. And I very, very rarely, and I mean very rarely, use any system, mainly because I'm maybe not so... I've had so many put in front of me that I just don't, I try them out, they don't work. Everybody says, oh, try this system. This is the best. This thing works. This is work, and then I try it and then the thing takes a shit. And then I'm like, why am I doing this? But I will say one thing about Tesseract, and we started out, not knowing all the nuances of it, and then Gagan took over the trading, and we've been profitable. It's a new thing for me. I like just now, Stock came in and talked about that February 2nd high at 28.31, and I had a gut feeling that you were supposed to get short up there, and they were still like 29 after they traded 31. They were still like 29.30, and I told Paul V in our forum that I think you're supposed to sell them. And while we were kind of going back and forth on the chat, all of a sudden the S&P sold off. So sometimes, you know what, you just got to go with your gut. It's a feeling that, and my thing was that we've gone, we had a 26.93 low, and we've got a 28.31 high. So we've gone basically 140 handles over the last 3 weeks or so. And what I'm going to do today is I've got a couple of slides. I'm really here just to introduce and let the other guys take it over. Hey, Marlon, are you still there?
Yes, I am.
Okay, well, thanks. Who's coming in first?
So we got Gagan coming in first.
Okay, that's right. Gagan coming in, and then David is second.
Then Peter, Davies, Jigsaw.
Peter, then David. Okay,
and then
all right,
David Dube is going to do cleanup.
Okay, great. All right, so I've got that straight. And in between there, I'm going to do a couple slides myself. And we've fairly successful crowd that we've got here. I was concerned originally that the timing of this being in the end of summer or the end of July, people kind of going on vacations, that we wouldn't get the signups that we thought we would. But over 600 people have signed up. So obviously there is some interest here today. I would just tell everybody to sit back. If you've got questions, be patient. Sometimes it's hard to answer all the questions because as the presenters are putting their slides out, I think sometimes it's better to let them do their presentation and then ask the questions after the presentation. But you think we're good to go, Marlon? Are we?
I think we're as good as we're going to get. Yep.
Okay, cool. I'm going to turn off my camera right now, and I'm going to do one slide, and then what's going to happen is in between the different presenters, I've got a slide for in between each presenter. And then at the end of it, I'll come back and we'll talk a little bit about the market. So if that's okay by you, we're going to begin right now. Okay, well, I want to thank everybody for coming in. I know it's like I said, the dog days of summer, and you know, I got to say one thing before we start. I don't think trading is easy. You know, when you look at Twitter, you see a lot of people talking about how profitable they are and their products, and what I've learned over a period of time is that whenever something is for free, or whenever somebody's out there talking this and talking that, especially about the way these markets are set up now, low volume, the majority of the volume being algorithmic trading and HFT and program trading, that what happens is you can have the right level and you can just get shaken out by one of these little blips. And the other day I did something on Twitter where I asked, if you're trading the S&P, what you think your stop should be. You know, is it supposed to be 2 to 3? Is it supposed to be 5? Is it supposed to be 10? And I was really surprised. A lot of people said 10 handles, and I've always tried to be a little bit more of a perfectionist and try to pick a level. Let's see, where's D-Boy? Okay, okay. Well, anyways, there's some people are asking Marlon if about a sound check. I don't know if they can hear, but anyways, today we've got 3 powerful ways to improve your trading. Pretty simple thing. Everybody's got their own way of looking and viewing the markets. All 3 guys today are very, very smart. They're not those kind of guys that are out there pushing products on, you know, Twitter, talking about how great they are. David Dube is a very, very modest kind of guy, very, very intelligent. Gagan and Tesseract, obviously there's been a lot of time put into the stuff that they're doing. And last but not least, Peter. Peter's a very smart guy. I mean, we've had Peter on. I think some of his presentations, to tell you the truth, are some of the best that I've ever seen in the business. So anyways, I've got one quick slide, and then I'm going to turn it over to Marlon to bring in, who's going first again? Oh, yeah, Gagan, I'm sorry. Anyways, I should have wrote it down. But anyways, when I talked to the Pitbull quite a bit, and one of the things, he called me just a little while ago. One of the things that he's been pointing out, it really hasn't been for the last 6 months or anything like that. It's really been for the last year and a half or two, is FANG. And he's constantly pounding on me. And I think we saw this in February when Facebook cratered and they got in trouble for selling their list. That the game is really run, but I believe it. I really do. I believe this is really true. That if you want to know where the stock market's going, you got to follow FANG. You really do. 3.426 trillion market cap. We've never ever seen anything like this. And I remember during the days of the 1999-2000 tech bubble, was that there was these day trading stock rooms, and I'm going to try to get this over real quick. And the guys would show up with their puka beads, and they're in the middle of the summer, and we'd be downstairs at the bar at the Merc or in the Merc Club, and these guys would walk in and they'd talk about how they made 50, 60, 80 grand a day. Some guys were making 100, and I had a good friend who used to talk about his one buddy. I think this is completely different. What was the difference is back then is that a lot of those companies in the tech bubble, they had no balance sheet. They were just a name. A lot of guys that were buying those in those tech stock day trading rooms, someone would say, "Hey, buy XSG." Well, they didn't even know the company what it was. They didn't know the product. They didn't know the balance sheet. They didn't know anything about the company. But yet there was some craze to go buy this stock, and they pushed it from, a $10 stock up to $80. Well, we all know how the tech bubble ended in 2000, and it ended badly. I mean, there were people that hung on. I know a particular friend of mine that owned triple Qs. He bought triple Qs instead of buying tech in the tech bubble. And he had to hold on to those triple Qs for like 7 years, 8 years in order to get back his money. And I don't even still think that he got back to zero, but obviously the NASDAQ has made new highs. But like I said, the pit bull drives this into me all the time. And I think if you're trading today and you want to get a good grip on the direction of these markets, I really think that you should have these stocks up on your screen. When all of them are positive and the NASDAQ futures are moving up and you see this kind of stuff like we've been seeing, I just think that this is really, really something to lock on to. I personally don't trade these individual stocks, but I do remember what happened in February when Facebook sold off and took everything with it. But then again, with a market cap like this, I think that these are the 5 stocks that are controlling the market right now. And I've got another couple slides coming up, but we're going to turn it over to Gagan to come in and talk about Tesseract. And like I said, I've got a managed account with them right now. I very seldom do that, but I'll let him take it from here. And thanks for everybody for coming in.
All right. Thank you, Danny. Gagan, you on?
Yes. Can you hear me?
I can. Hopefully everybody else can too.
Yeah. Okay. Fantastic. Well, everybody, thank you for joining us here today. It's great to be here. Danny, thanks. Marlon, thanks. And everyone at Top Step for giving us the opportunity to do the presentation with you guys today. Just very quickly, I'll give you some background on me. So I've essentially been a broker or sales trader for about 14 years, based in London. I traded my own account for about 10 years and still do to this day. And like probably a lot of guys out there, well, I'd certainly say me more than any, I think I've probably tried every indicator type of analysis from DeMark, market profiles, cycles, fractals, Elliott wave, you name it, I've tried it. Now, and Danny touched on this earlier. I found about 5 years ago, trading sort of started to get harder and harder. And I really couldn't walk in to the office or to my desk and be confident that I could sit down and take something out of the market every day. So then about 3 years ago, I would say for me, it was like a lightning bolt. And I met Dr. John Papadakis. John is essentially the main guy behind the model. He built it, he monitors it, he manages it, and he refines it. Everything on a daily basis. John holds a PhD in nuclear and particle physics from the University of Athens. And look, he's still there, and he's still
Gagan, we've got some technical issue here. Sorry. No sound. All of a sudden, something cut out. If you've got no sound, you're going to have to re-enter. 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 You can hear me, Gagan, right?
Yeah.
Yeah, I don't know. All of a sudden, no sound started pouring through, so.
It seems some people do, some people don't, right?
Right. Okay. Hang on. So if you lose sound, use the reconnect button. Thank you for. Okay. All right. So let's just get a couple seconds for people to reconnect. So evidently they got lost at sound stopped at John holds a PH. I assume D.
Okay, no problem. I'll recap. So,
okay.
John holds a PhD in nuclear and particle physics from the University of Athens. He currently still lectures there, still teaches some students there. But I'll go back to this. I mean, look, it really was a chance encounter on a trading chat. I think that they started off with 3 people. And the idea was really just to share trading ideas, swaps of analysis, exchange charts, etc., like anyone does in trading chat. But look, eventually, we all essentially started following John's trades. And so that chat expanded to about 150 people, really just waiting on John's trades on a daily basis. So the natural progression from there was to really charge for the research. And so John set up Tesseract as a company and a website. And I'll go through in more detail now what we're all about and what the site's about. Okay, so the key points I guess I'm going to cover is what is Tesseract, the principles of the Tesseractian model, the output provided, i.e. the information you'll be able to use from the website, and really the way a trader should approach the model. Okay, so well, look, what is a Tesseract? Some of you may know, some of you may not know. Really, a Tesseract is a fourth-dimensional cube. You can see in the slide a two-dimensional projection of a Tesseract. And the choice of the name reflects the ability of the model we use to predict target price zones. So let's take this example. Now, I know this is going a bit off key, but it will make sense, I assure you. If you imagine standing in front of a table, well, we are three-dimensional beings, but you can see everything on the two-dimensional table. Similarly, someone being in 4 dimensions can see everything that's going on in the three-dimensional world we live in. So we feel that the Tesseract model gives us the ability to monitor the market from every perspective. The site itself is essentially an online community of interactive traders where they all use the model analysis and the trades that we provide. And I'll go through that now. The principles of this model, again, bear with me with this, but it will give you some background to this. Again, it's a statistical simulation of the moves of trading instruments based on a quantum model using wave functions to calculate probability densities of certain price zones. So the model assumes that the instrument, whether it's the FTSE, the S&P, the DAX, is a version of a quantum particle moving around in space like a wave, okay? And this is being described by a function from which the probability of finding it in certain areas can be calculated. Okay, so what do we get from the model's output? Well, first of all, we look for a bias, okay? Now, why is this important? How many times have you seen traders trying to short a rising market only to get stopped out continuously? I mean, look, we all see it all the time, right? Because your orthodox indicators, the levels that you look at, they all start saying it's overbought. You mentally think, right, it's gone too far too quickly, I should short it. Alternatively, I mean, this is a good example recently where we had a lot of comments about gold. Everyone was looking to try and buy it between sort of 1280, 1240 in this sort of range. And again, it's continued to fall. We were down, what, below 1220 the other day. Currently, we have a target of 1204. But the point I'm saying is, because it's been falling down, people thought they saw some value on it, and so they tried to buy it. And really, they've essentially been stopped out or are holding it or holding on to a loser. Now, again, here's another example. Traders who are trying to trade both directions to catch every move. They may have a great run, you know, on a move up. Then they, you know, you've heard this all before. He said, oh, I made loads on the way up, then I started shorting too early and I gave back a lot of my gains. All stuff we've all heard. Now, the whole point of a bias in regard to our model is it keeps us bullish and it keeps us in the right direction. The old saying, the trend is your friend, etc. Well, I'll give you an example at the moment. If we have a bullish bias, if the model has a bullish bias, then we will only buy the next dip levels according to where we have high probability reaction points. So I'll give you an example. You can see on the diagram there, and what I'll do, I'll just highlight this. See if we can do this. Here, model targets. Okay. 2832 was a short-term target. So in the last week or so, couple of weeks, we've been trading for this target here, 2832. So we bought dips for these levels. Now, that is because the model has a bullish bias. If it has a neutral bias, then what we would do is we would consider trading both ways. Bearish bias with gold currently, we would look to sell the rallies. So first things first, we come in the day, we know we're looking to buy dips, right? It's very clear to us. Mentally, we are prepared for it. Just turn this off. Next, the targets that we get have a probability of over 95% of getting hits. So remember here, we come in, we know that we want to go long or short. We know that the targets that we have are going to get hit to a high probability. Then what we're looking for is which areas to buy. Where is the likely reaction? Okay. Now, I'll go over this again. We have all of these levels here. Okay. And what I'm going to explain is how to interpret them. So we know that the market has a bullish bias currently. We know that we have a target here, 2832. Now, what do we do with that information? We look for entry points. These are highlighted in key level areas. So 27.95, the last couple of sessions, 27.90 would have been good levels to buy. Now, after the first hour of trading, we have another set of levels here. These are the volatility coming on in the market. Everything's going fine. All of a sudden, market has a quick spike lower. So what do? Do you stop out? Do you buy more? Or do you close your position and wait? Well, I think it's happened to all of us. Now, with this system, you will have the ability and foresight to know that if there is a spike down, which areas you're likely to see a reaction point. So let's say today the market is trading at 28.30. Well, for argument's sake, if these were the volatility levels for today, we would suggest 27.90, 27.84, all the way down to 27.70. So if there was a spike down, because we have our bullish bias, because we know we've got our 28.32 target, we also know where we want to do business if there is a sell-off for whatever reason. Okay. Now, the next thing you will get from this service, which is, I would say, one of the highlights of the service more than anything, is these specific trade ideas. I would say on average between 3 to 4 days a week. Some days it's 5. We will have a model buy order. So despite having all this information, it will still give you an actionable trade idea. And I'll show you the performance shortly. But very quickly, the order which the model trade sort of ideas are highlighted, shall I say, is here. It's very clear. Model buy order, SPX. So the trades are issued in SPX. You have to adjust for ES levels. But here, 27.64, stop loss 27.44, target 28.32, and then it gives your risk management. We generally want to risk 1% of your total account on trades. Now, if you're an ES trader, you obviously have to amend your risk slightly. So what I would say is you need to occasionally look, some of those trades will have 10-point stops, some will have slightly wider stops. Now, what's the reason for the wider stop? The reason for the wider stop is we want to not be knocked out of the trade, so we put the stop below key reaction points. So for example, if we see the buys at 64, we may have buy levels all the way down. So we actually want our stop below that, because otherwise you could get stopped. Suddenly it bounces back and you're left holding the bag and you think, I was right, but I got stopped out. Okay. Okay. Next slide. We also issue a daily path. What is the daily path? Okay. Again, if it couldn't be clearer, on a daily basis, a few minutes before the market opens, and I would say for the last 2-3 weeks, I've been sharing these on Mr. Topset on the site. And I would say on average, the path we probably get right, or certainly John through his model gets right about 80% of the time. Okay. It's not every time. That's just the nature of trading, but 80% of the time. So how would you use this? Well, for example, here, this was a couple of days ago. I believe it was yesterday, actually. Before the market opens, John's model predicts small move up down to 27.95 for an initial target of 28.11 or 28.08. But there's always a chance it could go straight up there as well. So we give the alternative scenario. Now, let's see what actually happened. Well, we had a move down. We didn't quite get to 94, but we got to 92, and then we moved straight up. And that is basically what you're going to get every day. And I would say 80% of the time, these maps work. So you should start building up a picture of what's on the website. Now, let's go back to the trader's approach of the model. So now we know a trader needs a bias, whether he should be buying dips or selling rips. He needs an entry price. Yeah. An entry price we give it relatively specifically. You can get that from the model table. You can get it from the model signal when John basically takes away the work and essentially gives you the trade. He gives you the target. The target is extremely important. Now, how many people take a trade, they put their stop in and starts to move up, and they're thinking, oh, I'll just raise the stop. Well, the model will give you a level already where you should be taking a profit or certainly scaling. Because once it touches those levels, there's always a good chance that it reacts lower because we've completed a target. So already we know we're coming into the day, as I said, you know you're going to buy a dip, you've got your entry, you've got your volatility levels if there's a spike lower to add. You know where you're targeting to on your trade, and then you have your stop. Again, your stop is lower than those key levels. And all of those things combined are how you get success using the Tesseract model. Now, you can use all of this information for day trading, okay? We've actually been trading Danny's account using all that information, and I think he's up about 10% or so in a couple of weeks. But we can also use this information for core trading, as we call it, for longer term swing trades. And I'll explain that. Well, I think the performance will explain that. Okay, so let's go to the next slide. Here's the performance. Okay, looks pretty spectacular. It's pretty much good because it is. Okay, in February, performance was about 16.5%. And you probably asked why that's a lot bigger than the other months. Well, as we all remember, the market was extremely volatile. So if you imagine most days when the market was moving 300-400 points, every day after the market opened after the first hour, we knew good reaction points. We knew from our third volatility level that if the market did get down there, we would see a good reaction. That performance there shows you how the model did in a highly volatile environment. March, April, and May was pretty much between 4 and 5%. Well, 4 and just below 5%. You can see there. Again, we were building positions for the big move up, and I think we were holding 26.30, 26.65 for about 3 months, and that added to the later performance. We're still holding a part position in the Nasdaq. In my opinion, if we touch the upper levels, the other upper model targets on the Nasdaq, I think we make about 1,000 points on that trade. Okay, so what we're offering here today is a 2-week trial. I spoke to the guys. You don't have to put any credit card or debit card or anything that down. You essentially go onto that link, www.tesseractacademy.com/promotion. You've got about three columns to fill in: name, email address, and then you will have Tesseract for 2 weeks. You can use the live trades, you can use the analysis, and we've also done this. We're going to have, whether it's myself, John, a couple of the other partners, or even some of the current subscribers, we're going to have a sort of hand-holding experience. So how many times have you signed up for a trial? You go on, it looks a bit complicated, and you think, I'll come back to it, and you never do. And then you go there again in a couple of months, you think, oh, well, maybe I'll have another go. Well, the idea really is that once you log on, someone or they'll be able to help you and show you around the website, etc. And they'll be there for a few days, a week, however long you need. But the idea really is that you guys can make a bit of money, like that's what we're all here to do, from using the analysis, get au fait with how the levels work. If you have any problem, you can ask someone, and then look. As I said, to me, the way I would just best describe this, I feel it's like looking at the market now through glasses, and I wouldn't even dream of trying to trade the market without using this model. So, as I said, all you need to do is go to that link at the bottom. It'll probably take you about a minute to sign up. Give it 2 weeks. We'll help you. As I said, it doesn't cost you anything. And then you can go from there. But I would probably say our ratio of conversions is probably around 90%, because once people start using it, they like it and they feel that it's a great addition to their trading. Well, look, guys, thank you for watching. Thank you for the time. Do you have any questions?
And Gagan, too, on their screen, guys, on your chat area, there's a link there to click to take you right to that, and I'll leave that up for a couple more minutes.
Yeah. Marlon, do you have any questions for me?
Oh, there's a question. There's a question wanting to know how long your code's going to be valid for, the Top Step code. Some people have 2-week vacations,
Look, what do you mean? Like, how long it's going to be available for? Is that what you're asking?
If I'm going to go away for 2 weeks, can I do it? Can I join 2 weeks from now?
Look, if you send us an email, you mentioned Top Step, sure, we're easy. We're happy to oblige. Not a problem.
And Al's got a good question too. What are the markets? What are you trading in? What are you providing data for?
Okay, so we have the S&P, the DAX, the FTSE, the Nasdaq, the Dow Jones as the main indices. In currencies, the major ones: USD JPY, GBP USD cable, GBP EUR, sterling against the euro. They're the main ones. There's also some extra analysis John throws there. There's a great one on Bitcoin. I mean, I would say if any of you trade cryptos, sign up just to be able to see his view on what Bitcoin is going to do. And I'll save that for the site. There's also oil on there as well, and gold. But I would say pretty much nearly everything most futures traders are trading, all those asset classes anyway.
And you're using all cash indexes, right? You're using all the cash values.
Yeah, so the prices are in cash. Recently, we've started putting an amendment. If you're an ES trader, you know, add 3 points, etc. Ultimately, we want it to be as simple as possible. You come in the morning, you look at the morning analysis, you look at the path, you know your levels, and you wait, and you basically pick your trade. And, you know, we found through that performance, you'll get consistency like that. Not trying to trade every day, just trading when everything lines up. Yeah. And look, it may be the case you have, you know, a month of, you know, trades every day, and other months will be quiet. That's just the way it is. But you probably won't lose money in that fashion. As I said, it's just it takes a bit of time, but you know, we're not looking to trade every little move. We're just looking to trade when everything lines up.
Someone said that the coupon code is invalid, but actually it doesn't even ask for a coupon code. I just quickly went through the process. So make sure you guys are.
Yeah, essentially all you have to do is.
And here's the link there in chat. So make sure you guys use that link. The other question was, what's the cost after the trial?
Okay, cost after that is $150 a month. So what? 3 points on the S&P to break even. Or the ES, should I say. Yeah.
Perfect. And so Mike has registered, so it is working fine.
Yeah.
Okay, so I think we're almost ready to move on. Yeah?
Yeah. Okay, well, look, thanks, guys. Any other questions or you want any more information, just email into the website. As I said, you've got the link there. Take a shot. It'll be worth it. And as I said, we'll help you guys make everyone some money. All right.
Right. And I want to make sure you guys don't leave frustrated that you didn't get enough information or you wanted to spend more time. Everybody speaking today, I got to tell you, everybody speaking today, including myself, are easily accessible. Okay, so get a hold of me, Marlon at MrTopStep.com or whatever. I'll get you in hold of anybody. But you got 2 weeks of one-on-one helping you to understand the Tesseract model too. So that's a really fantastic. Right, there is no coupon box. So if you click on that link I just posted right here, and you go to that site, it won't ask for a place to sign up. Okay, so we're ready to get Danny. Let's move. Otherwise, we'll be here all day. We'll switch the presentations. So stop that. And this, here we go. So this is where Danny left on. You back, Danny?
Yeah.
All right.
And we got my next slide. Okay. Anyways, thanks, Gagan, for coming in. I think you did a great job.
No problem.
Again, I think the important thing here is with all this algorithmic trading going on, like I tried to explain a little bit earlier, you get an idea, you put in a stop, you get, your level's not perfect or exact, and all of a sudden you get knocked out, and then the market moves, in your favored direction. And while I tend to be a little bit more impatient, what Tesseract has kind of taught me to do is to wait for the levels. I think what we're waiting for now is like the 22 or the 28.18 level for an entrance to get long the S&P. Isn't that right, Gagan?
Yeah, that's for today.
So that's what we're looking for. I know a couple of guys in the room had 28.17, 28.18. So it's a matter of being patient. And the other part about it is the other question I wanted to ask you. So the service total is $150 for all markets, right?
Yes. To be honest, you get a lot of stuff from that. I mean, I think really, I think a lot of other sites, they charge you 150. Then if you want more indexes or commodities, they charge you more. It's priced well. Look, we've only started it 6 months ago. Whether it stays like that in 6 months, 12 months, I don't know. But that's what it is at the moment, $150.
Okay, cool. Well, thanks a lot. And let me jump into my slides so we can get David in here. And Real quick, I mean, when I was talking to Marlon about being a present, helping out with the webinar today, I figured I'd throw up a couple slides. And one of the big questions that I've been asked a lot on Twitter, people sidebarring me, is what I think about gold. Well, to be honest, one of my first jobs on the trading floor was working at the old market on Riverside Plaza before they built the new trading floors on Wacker. And I ended up to be a clerk in the gold pit. And the gold was like trading like $250 to $300. I mean, that was like on the high end. And then I can't remember what the event was, but gold shot up to like $600 or $650. And I mean, what you want to talk about, there was something back in the day called dual trading in the S&P, and that was where I could give a broker 500 to buy. Yes, they'd buy 500 per share, and the guy in the pit could pop off a 50 lot or a 100 lot for himself and then bid the 500 lot up. And in the gold, these broker groups in the gold pit, back when I remember when things were really, really moving and the gold was gapping up $50 at a time and stuff like that, there'd be two guys in the same broker group. One guy would have 300 to sell. One guy would have 400 to buy, and they work with each other and $50 trading range. And they'd just put a guy in between the trade. The guy that had the 300 to sell would sell 300. They'd wait for the opening range to get established, and all of a sudden, the guy that had 300 to sell, he'd sell the 300 on the low tick, and then the guy that had 400 to buy, he'd turn to the guys that bought the low ticks from the guy that sold the 300 to the guys and then buy the top of the range with his 400 lot to the very same guys that got the buys on the low ticks. I mean, I remember this so vividly. I used to just look at this and think to myself, this is unbelievable. And back in the day, that was a big thing. I mean, there was something called, yes, it is recording. There was something called dual trading where you could do this. And I think that, along the way, while I think electronic trading has made it a more fair and level playing ground, I also look back on it and I tell myself, well, they went from the crooks in the pit that were doing their stupid shit to letting all this algorithmic trading and HFT trading take over the tape. And really, the way I see it, the CME has kind of forgotten about where it came from. I think originally a lot of the smaller accounts, the retail guys, were made up a big share of the volume on the trading floor back in the day. Now, 80% of it's electronic and program HFT and high frequency trading. So, guys like us, we're kind of a rare breed. But anyways, I do get these questions about gold all the time, and I saw an article in the Wall Street Journal and this other one from the Futures Trading Commission that gold has gone down considerably as interest rates have risen, and I think I don't think that trend's going to stop. It's a big risk on, risk off trade. When gold's hot, everybody wants to buy it. I was on a radio show recently where they were talking about gold, and I said, it amazes me that whenever gold starts going up, you get these commercials on TV, buy the gold bars, buy the silver bars, good for your retirement. Eventually that may come true, but you know what? I don't see gold breaking out. I to tell you the truth, I really thought 1350 was going to be a big area in gold. I didn't know it was going to sell off the way it has, but I didn't think it could extend itself much further than 1350. And as I said, and as the chart shows, as the central banks continue to raise interest rates, gold's really fallen out. It's just fallen out of bed. And the other part about it, I don't know how many people trade gold here, but I know there's a lot of people that love to trade it. But I don't see a bull market in gold unless there's some kind of war, some kind of catalyst, a risk on, risk off trade where everybody puts a risk back on. But I could see gold really actually falling down into the 1100s at some point. And the other part about it is when these big hedge funds, I think I think it says that the hedge fund speculators have ramped up their short bets. Well, the short bets by these hedge funds have totaled like over $2 billion in short bets. So on the flip side of this, I think that while it's fallen, and then you know that there's over 200 billion or 2 billion in short bets in gold right now, there's probably a possibility it can pop back up a little bit. But again, I can see gold falling to 1150. I really could. And in the long run, I just don't think that it's a good buy right now. I still think with the Fed raising rates and no real global risk, it's going to continue to fall. But anyways, next up is we've got David Dube, very, very good guy. I mean, we've been working with David for several years, encouraging him to come work with Mr. Top Step, and he's finally.
Hey, Danny.
Yeah.
You had a 50-50 shot there. It's Peter Davies next.
Oh, I'm sorry. I had a 50-50 shot. I blew it. Well, either way, David Dube is a great guy. He'll be the third presenter. But Peter Davies is coming up. I'm sorry about that. Again, I should have written this down. Peter's got he's got technical systems that he is just fantastic with, and he actually gave me his software. The other part about him is he's a great guy, and I spoke to him today. He lives in Thailand, and he's a great presenter. So thank you, Marlon. I appreciate that. Give me a heads up on that. But anyways, listen, I'm going to turn it over to Peter. And again, thanks for coming in, Peter. And sorry about having this backwards. Thanks.
Hey.
Jigsaw Trader.
I've been called worse, Danny. Don't worry.
Yeah, I'm sure. Thanks a lot. Sorry about that.
Hey, no worries. Right. So can you guys just give me a Y in the chat if you can hear me okay? And either nobody can hear me or nobody's got a Y key.
Yeah, it's a long delay between when you
say.
It's
a long delay. Okay, let me just carry on.
You're going to get a lot of Y's in a second. There you go.
Yeah, just tell me if you can't hear me. Okay. So what we're going to do, this is quite a short talk today, and I think that's kind of cool things. Some of these webinars drag on. So I'm going to get right to the point. What we're going to discuss today is something that people tend to gloss over in trading. Now, my background, I'm a discretionary trader. I work with a lot of discretionary traders. I work with a lot of discretionary trading prop firms. So that's really my perspective. That's what I deal with, and that's what I can talk about with some authority. I also work with a lot of retail traders. Without doubt, looking back, even in my own trading, I think it's possible that way back I was actually had in my hands a profitable trading system that I didn't make work. And the fact is, most retail traders, if you gave them a profitable system, they would fail, right? And we're going to have a chat about why that is. And we're looking at how you can actually get on the path to actually turning your efforts into money, and how within 2 weeks, okay, this isn't a fictitious claim, it is 2 weeks, you can have a radically different outlook on your trading altogether. Now, before we look at timescales, and I just want you to think about your goals in trading, because when I talk to traders for the first time, I'm usually talking to people who have been through all the magic indicator stuff, right? So they've been through all that. Why doesn't the moving average crossover work? And why don't my horoscopes and moon phases work? They've been through all that. And they're talking the first time. I said, look, what is it you're trying to do here? And you can just tell, man, that these traders, they've been just totally beaten up by the market, because most often they'll say something like, well, in 12 months' time, I'd like to be able to cover my commissions and maybe make a small profit. And it's just, God, you sound so meek. These aren't meek people, but they are meek when it comes to trading. Trading has basically roughed them up a little bit. It's cut their lip, and they don't want to say anything that will make trading come and get them again. It's like trading has become the school bully. So what they're saying is that they're quite happy to have a 12-month goal of earning less than minimum wage from trading, right? And considering how much time a lot of people put into this with zero reward, they would actually be better off with a part-time job at McDonald's. At least they'd be out of the house meeting people. So what I'm going to do now is I'm going to show you some of the end goals for traders, right? This isn't fictitious. This is traders I know, okay? Traders I've worked with. And we're going to see what traders working in a controlled environment, some of the best traders and some in the middle, actually get along, okay? And when I say a controlled environment, I mean with somebody looking over their shoulder, ready to pull the plug on them if they lose. How people in a professional environment are trading. Okay? So first of all, let's not dwell too much on the guy on the left. You know, I lost 25,000 but didn't tell my wife. I do meet people like that occasionally, and it just boggles my mind that you would do that. But, you know, it's just complete lack of discipline. That's the opposite end of the discipline scale. Now, depending on the trade style, the first level of success is basically, well, I'd have made money if it wasn't for those damn commissions. And that's very common, not just in retail traders. It's very common in prop firms where they force you to trade multi-leg spreads, especially right now on interest rate products, because of interest rates being so low. So there are prop traders right now who have got like quasi-profitable systems but just can't overcome the commissions. Now, there's probably another discussion to have again about kind of those kind of prop firms. But if you do go prop and you're told to place 8-leg spread trades, your prop firm's making money on the commissions. Now, typical first profits in a prop firm, the guys that are trading outright positions, you know, buy to sell higher, usually around $200-300 a day, right? And that's with the imminent threat of being moved back to sim and a very, very tight control of risk. Now, when I say tight control of risk, if you lose $1,000 in a day early on, you're probably going to go back on sim, right? But there's some flexibility, right? There's some flexibility. They don't expect you to be robotic, and they know that some conditions are a bit harder, and they're going to be obviously a bit cognizant of that and take that into account, right? But anyway, control is risk. If you mess about, you screw around, you're back on sim. Usually they're trading a single strategy with a very narrow kind of focus. So basically it's the kind of walk before you run kind of trading. Now, as those traders progress, it's quite normal for the guys who make it to the 200 or 300 a day level, and not all do, obviously, to get to 2,000 to 4,000 around that area a day. So they're still having losing days, but now they've reached a level of success. They've got a bit of a spring in their step. Puts them way ahead of most retail traders. Now, at this point, they're allowed to take on a wider range of markets, a wider range of setups, do a bit of experimentation, put some small money on other things. In other words, they've got a bit of respect from the firm. They've got a little bit more leeway in terms of size of trade and strategy. Right. Next level up, as the guys get more experience, we get to the guys who are pulling in 10K plus per day. These are good guys, usually 1 or 2 years in at least, more size, more trust from management, more aggression at scaling into positions. And also one of the things, the ability to switch very quickly as the markets change pace. You're almost like reptilian in their abilities, where they can just be watching the market, then bite, the market takes off, and they just jump on it. And a lot of the trading is like that, right? So guys that are making $10,000 a day, quite a lot of the time, what they're doing is seeing a market start to run and just piling in onto it, right? Just getting on a momentum move, but also not getting caught like a deer in the headlights when the market turns against them. Now, there are levels in between. The guys on 10K, you know, they might do 30, 40K on a good day. And then you've got the guys, the kind of outliers. I've met 3 or 4 of these in my life, guys that are regularly pulling in 100,000 a day. I can think of a few, you know, significant cases. There was a guy here in Thailand who was 30% of the trade on one of the Singapore markets. I've known a guy who's been about 30, 40% on the bund at certain times. There's a guy I know, again, a guy I know travels around. He was trading 30 million in hedge fund money, could regularly make 100 to 160,000 a day. Basically, they're guys that have got a lot of balls, basically. They're not scared of the market. They'll pile in. But also, the skill that they've got at that point, it isn't the same as the skills before, right? What they're doing is a little bit different. They're actually pushing the market around a bit, right? So they're kind of pushing people out of position. Now, there's a reason you've got to understand this, right? First of all, you have to stop with the minimum wage mentality, right? You got into the, you know, you hear all this, you know, you see these things on the internet. Oh, if you say you got into trading for the money, oh, you're never going to make it. You don't love trading. You don't have to love trading, man. You got into this at least partly for the money. So if you want to earn $1,000 a day, don't be shy about that, right? Because considering how much time and effort you're going to put into this, there should actually be a decent reward. Plus, as you're putting in the time and, you know, taking it seriously and putting in the effort, it's going to be a lot easier to stay on track, because this isn't easy if you've got sights on a decent goal. But much more importantly than this, you have to consider is, do you think the skills to earn 200 or 300 a day are the same that see you cornering 30% of a market or making $100,000, $200,000 a day? Is it just the same method scaled up? And the answer to that is, of course it isn't, right? But also, who do you think is teaching the traders to corner a market like that, right? There's not one guy in the prop firm that's making like 500 that's a day that's teaching the guy to make 100K a day, right? These guys are doing it and getting there on their own, right? There's no class, there's no course. So from my experience, talking to the traders doing this, nobody taught them. It's just where they ended up. Now, that's kind of somewhat disheartening to traders who are still trying to make their first profits. But like, how does this happen? Well, first of all, these are exceptional individuals and they've got no fear whatsoever. But mostly they've got no fear because they're not trading their own money in most cases. So they're the kind of 1%ers. And these guys at the start of their careers, they were given trading techniques just like everyone else. But more importantly, in a professional environment, which they all came from, they were given the knowledge and tools to become self-sufficient, right? To see edges in the market and exploit them to develop as traders themselves, okay? So the starting point's the same for everyone. It's just getting on the path. And that's really what we're going to try and get you onto today, with something that's going to get you results within a few weeks, right? So first step in our 2-week plan is to figure out the best market and time to trade. Now, you are not going to get profitable on replay. Or rather, if you do get profitable replay in the US morning, for instance, but you can't actually trade then, you've got no long-term plan, because you're not going to be able to give up your day job because of your replay profits, right? So what you have to do as soon as possible, if you don't do it already, is find a market to trade when you have free time. Now, that's not rocket science, right? Most people are working, and it's the rest of the time you have to trade, despite the amount of people that use our software and say, can I get another license to use in the office? Right, so in the US evenings, there are actually Asian markets you can focus on, Hong Kong and Osaka. For those on the West Coast, you can wake up a little bit earlier and trade before work. And for a retail trader, 2 hours a day is a good target. And after our 2 weeks, we're going to actually add some additional time to that 2 hours a day. But my personal feeling is that for somebody working a full-time job, any more than 2 hours a day, you know, for somebody that's doing that, it's overkill, right? There's got to be some balance. And 2 hours is a lot of time to be intensely focused on something. And you're going to need time to unwind afterwards too. Because like, if you're like me and I trade in the evening, I can often be watching TV at 4 a.m. because it's been an exciting day. So what you need to do, first thing you do, you find your 2 hours a day. And based on that, you're going to have a range of markets to choose from, right? And then you need to narrow that down based on 2 factors. The first one being, which market has a sort of volatility profile you like, you know, like a fast or a slow market, and which is likely to give you multiple setups in a 2-hour period. So setups like volume spikes, momentum moves, iceberg orders, volume profile steps, big obvious things where there's admittedly sometimes more competition for the trades, but they're kind of the best places to start off. The more subtle stuff you can kind of bring in later. Now let's just backtrack a little. What exactly do we mean by a setup, or what makes a good setup? Well, for a lot of people, a setup is a hodgepodge of factors to kind of determine, you know, what's the market trying to do, and then to trade towards that. But what professional traders are doing is they're basically figuring out what the market's doing right now and trying to trade with that, right? Now, the former, generally speaking, doesn't work because you end up with this kind of rule set that's so loosely defined that for any given day and scenario, you could arguably go either long or short, right? So it doesn't really lead to consistent behavior, you know, because for all the factors you're taking into account, a lot of traders have just created this framework that allows them to get into the market at any time at all. So when I talk about a setup, I'm talking about using a more rigid set of rules and limiting what you do. I'm also talking about something higher frequency, something with less factors taking into account, something where you're not trying to guess really what the bigger picture outcome is, right? But the absolute limit, if you are not profitable now, for your 2-week plan, is you pick one market and you pick one setup in that market. That occurs frequently. And of course, this is where people say, oh, to hell with that guy and his opinion. But if you've got 20 different setups right now, or you're just trading off the cuff with no plan, and you're not making any money, you're not going to, you've got to scale back, right? Just scale back for 2 weeks, see what happens. So if you're not making money now, go back to one setup. If you can't make money on one setup, you will not make money on 2, 3, 4, 5, 20, or 50. And you won't make money trading just some kind of general opinion on where you think the market might end up. Now, remember, this is basically a journey that you're on here. So profitable is not actually your end goal, right? It's a milestone you need to get to. And the sooner you get to it, the better. So the setup is basically something you've observed in the market, or something somebody's told you about in the market that you believe causes a reaction. And I say believe because if you're not profitable, you probably don't actually know if it causes a reaction reliably. So in very simple terms, the edge or the setup is basically being able to see something occur in the market in time to be able to exploit it. Now, the next step in our 3-week plan is basically to stop trading. Okay, I just want to stop there for a few seconds. And I just want you to just think and just go back a few seconds in your head at what you thought when I said you should stop trading. Now, many of you will have felt shock, revulsion, maybe withdrawal, or at least some sort of negative reaction to that idea. Now, seriously, just take a minute to go over what came into your head at the mention of not trading. Don't associate that feeling with negativity, but just have a look at yourself, observe how you're reactive. It's not a good or a bad thing, but it is just a thing. Now, I know this because I've taken a lot of traders through the process that we're going to go through now. And this is the one single thing they have the most trouble with, right? Because people equate clicking buy and sell to trading. They equate clicking buy and sell to working, to progressing. So traders that have gone nowhere in 5 years clicking buy and sell still feel that if they have 2 weeks without clicking buy and sell, that they're going to go backwards. And it's an ingrained belief for many. And it's problematic because you actually need to discover if an edge works before you start trading it. Now, for people that have done this, okay, what we've done is we just get them to observe the behavior for 2 weeks, how often it occurred, what was the outcome, what else was going on in the market, what was going in correlated markets, but do not trade. Just watch your setup. We'll have a look in a second what happens if you do trade. Okay, so those that follow it, they've all done so. All the people I know that follow it have all done so under my supervision. So I'm going to be able to show you some results. But I would say that if you do this, basically just take a setup, observe it for 2 weeks, how often it happens, what the real outcome of that setup is. You're going to learn more about the market in that 2 weeks than you've done in the past 12 months, right? And I would also advise finding a friend or a partner or your spouse to report back to every day, because it will keep you on track. Now, I'm going to show you a couple of results of people that have done this. Sounds almost too simple. So this aspiring trader is actually a musician, and people like that are actually a lot easier to work with because they've already kind of gone through a big learning curve. And he's got 2 hours available in the morning before going to work. And basically, before I sat with him, he basically had nothing that worked, right? So 3 weeks before he'd started to put this together, he had absolutely nothing that works. And what we did, we sat down and we took a look at what he'd done in the past, and we had a look, and we found something that he kind of said, you know what, I really like that. And we had a look, and it was just a gut feel at that point. And I said, okay, just focus on that. See how often it happens. See how often that scenario pops up. See how often it fails. See how often it holds. And try and figure out if you got in on a limit order, not an aggressive entry, a limit order, or oh no, actually it was a market order, what the potential in that trade was. But don't trade it. And now, even after a couple of days, you know, he's like, oh my God, this actually could work. And within a few weeks, you can see he has now got an expectation of what the outcome could be if he trades that. Something he's never known in the 5 years he's been trading. He had never once known what the potential outcome of any of his trades was, right? So he never knew when he was in a trade whether he should stay in. He never knew before a trade whether he should get in. He never knew when he had a losing trade whether that was in the normal tolerance of that setup. And now this guy does know. And this guy is just in the process of going live with this. It's taking him a long time to get from here to go live because he's still kind of scared. And, you know, he's spent a long time with Sim on this. We've got another guy here. Okay, same thing. Now, these are different formats. And one of the things about this is there's a lot of people who say, oh, you've got to be mathematical trading. You've got to keep statistics. Well, if you're a statistical kind of person, statistics work for you, right? And if you're not, they're probably not going to. So, you know, I said to these guys, I said, look, however you want to put it, if you want statistics, if you want to draw a picture, whatever, however you want to put it down, just put it down in a way that you'll be able to use it later. Okay, so here's another one. This trader has spent 2 weeks. And after 2 weeks, he feels like, God, something's been really revealed, right? We're not talking about rocket science here, right? We're talking about something you could all go and do now, okay? And these results that we're seeing here are quite ordinary. And all we did basically, okay, I did help a bit, right? So I found from all the things he was doing, I found some of the behaviors he was looking at that probably these are a good place to focus on. But really, it was based on the knowledge that he came to the table. And again, this trader is also in the progress of taking this live, okay? So something very simple as just taking your foot off the accelerator and just taking a step back and saying, look, how well does what I'm trying to do actually work? Because you know what? That's exactly what you're going to do in a prop shop. That's exactly what they force you to do. They force you to sit and study and study and study. Now, why aren't people figuring this out on their own? Well, sim is not the answer. Quite simply, sim trading gives you an emotional attachment to every setup. So when you observe without emotion, you're observing the failed and the successful outcomes with kind of the same neutral objectivity, right? When you're sim trading, you can't bring yourself to look at the screen when you're on a loser, right? So you don't actually observe the losers on a sim trade in the same way. You feel bad when you lose. You look away from the screen. And I've yet to meet a trader that can be truly objective when sim trading. You know, maybe you're different, but maybe not. And in fact, this was a great one. This was so funny because right from the first day when this guy's putting these statistics, right, I got this from him, email every day. Oh, great day. Made money today. He says, I'll watch the market behavior primarily without trading. So instead of just observing the market, he's going to trade it. But he's saying primarily without trading because he says, I can open trades periodically if it does not impact my observation reading. This is a guy who's never made any money trading, right? I'm sitting with this guy, helping him, telling him what to do. And on day one, he's saying, yeah. Anyway, I'm not going to say anything because, right, I'm just working with this guy. I mean, he's a nice guy. And, I'm not his teacher. I'm not his boss. I'm not going to tell people what to do. He carried on. Day 8, $1,000 up. Then he blew up a one-up trading account. Day 8, I got a second email. I actually got 2 emails on day 8. Super frustrated, thinking what I can change in my trading process. I looked at the Stephen Kent. Dude, you're just literally supposed to be watching the market for 2 weeks and writing stuff down. Right? Now, you can see here what happens when you try and trade. It's all these emotions come in. You know, somebody's telling you what to do and you've somehow turned that into something else and getting frustrated when it doesn't work, right? And in the end, I had a word, right? In the end, I had a word and I said, look, you can do this one way or the other. You can either do it or not. It's not like 1 foot in, 1 foot out. And he finally got it. And he's now still having some kind of psychological issues because he likes to click buy and sell. But he's getting to the point where he can go live. So basically, the kind of message of this webinar is simply, it might be time to just take a step back and instead of sim trading and doing all the things you're doing, just find one thing that works. And to find out if it works, sit and watch it for a while. Now, of course, it's my belief as a day trader and knowing a lot of day traders that make, really put on really good numbers with high frequency trading is that you're going to learn faster if you actually make more trades. Okay, no, I don't mean over trading. I mean just find a setup that happens frequently, so you get a lot of time in trade every day. Okay, now at Jigsaw, I'll just kind of tell you how we can help. You know, so at Jigsaw, basically what we do is we approach trading from as many different angles as we can. Okay, so you'll probably know that we've got a trading platform. You can see it on this screenshot here. It's an institutional grade trading platform, and it's basically built around the techniques used in futures proprietary trading firms. It's fast, it's reliable, and contains none of the useless fillers aimed at attracting screen zombies. But a platform's not enough, right? We also have what I consider to be the best trading analysis tools on the market, tools that will tell you which of your behaviors is actually making money. You know, when you tend to win and lose in terms of time of day, day of week, which trades are making you the most money, which trades are losing you the most money, which instruments are losing you the most money, giving you the chance to compare periods against each other. So you can actually not just trade, but you can actually go back after your trading and have a desktop and a workbench that you can use to actually go through all of your results and try and figure out what it is you're doing that's working for you, and what the things you're doing that aren't working for you, and you should either refine or throw away. And of course, education is important. So you learn how to use our tools and you learn how to profit from them. And what we do at Jigsaw, we basically have 2 programs, and both programs contain education and also guides to take you through kind of the implementation and trade planning process. There's no point just learning a technique, right? If you don't know how to take a technique live, then the technique's not really going to help you. So what we do at Jigsaw, we've actually got 2 plans, because we believe that you should actually try and move forward from where you are now with your trading. And that's what basically this professional plan, the 879 is. It's basically taking you from where you are now and supplement it, refining your existing trade entries, so you can start a trade where order flows absolutely against you and you've got momentum against you, stuff to help you with trade management, supplementary scalping trades, to just basically make sure that, you know, if you've got something like a program where you pick levels in the market now, this will tell you when to trade those levels and when to start at those levels. So that's what the professional plan is. It's basically to take you from where you are now to where to get into profit. Now, there are people who come to us because nothing's working. And it's quite funny because sometimes, you know, I'll talk to people, how long have you been looking at trading? And they'll say 20 years. I'll say, well, what are the things you've done in that 20 years that have worked for you and what's not worked for you and what have you tried? And they'll say, I don't know anything. I'm like, yeah, but you've been doing it for 20 years. I mean, come on, you must have learned something in that 20 years. I don't know anything. And I'm not sure if they mean that or if it's just like complete lack of confidence, but it's like, you know, it happens. So there are people who believe that they've never experienced anything that's working, nothing's worked. And for those people, we have this, the course is a more expensive course, $16.79, but that was created by our prop firm partner in London. So this is a firm in the city of London that are trading the US, European futures every day, very, very profitably. And they created this end-to-end price data course, which starts off with basically getting an understanding of what state the market's in. And then they go into 19 various setups and talk about which market conditions they work best in. Now, I wouldn't suggest for a second that anyone start with 19 setups, but I would say, you know, you do that course, you take 1 or 2 of those setups and you try and find out, you know, a market that you want to apply those to at the time of day that you want to apply them. And then you start to move forward with that. If you want to apply one of the other setups, that's way down the road, right? You have to get to profit first doing something fairly simple, right? Now, today, the other thing we're going to do, we just got a special offer today, and that is to basically help you put together your 2-week plan, right? By helping you out with 2, we say 30 minutes. If I said an hour, it'd take 90 minutes, but basically we spend approximately 30 minutes. If it takes a bit longer, it's fine. In the first session, we basically take a look at what's working for you and, if anything, and where you should focus. So for the people with a professional plan, we actually do this right at the start. So right at the start, we'll sit down and look at what you're doing now and try and pluck out the few things that we think have the most potential to get you to profit. right? And then we'll say, okay, pluck at those things, and then we'll tell you what to do. And then the next meeting is at the back end when you've gathered your results, and we'll say, okay, this is the course of action you need to take based on those results. And the course of action is usually one or two things. It can be, it can be right, start to sim trade, start to find another market for it and get it to the point where you can get it live. It also might be, well, we picked the wrong thing there, didn't we? And maybe refine it or choose another thing. For the guys on the institutional plan, we actually leave that to the end because there's no point having those planning meetings if you're like hands in the air and saying, look, I know absolutely nothing about the markets. And if you want to take advantage of those, it is just for the guys in here. Just go to jigsawtrading.com/Mr. Topstep. And with that, if you've got any questions, I can answer them now.
Good job, Peter.
I can just have a look.
It's going to take a couple seconds for the questions to come in.
Yeah.
So those analytics, right? That trading, your trading result analytics is actually built into your platform. Is that right?
It's actually a separate website. So it is linked to our platform, but it's also linked to other feeds, CQG, Gain, Rhythmic, all those kind of things. So it hooks up to a lot of different feeds.
Dave's got a question up there.
Dave, I can't see his question. Where is it?
It says institutional trading from a London prop firm. Which firm is that? Axia Futures?
It is Axia Futures indeed. We work very closely with Axia.
Questions. What is the difference between Jigsaw bundled training and what Axia offers?
You can for that course, the institutional course, you can buy it from the Axia site or you can buy it from us. It's a little bit cheaper if you buy it for us, but not a huge amount. And the big difference is if you buy it from us, you get our support with it. So we kind of have an open door policy at Jigsaw. We've got a chat room that I'm in most days, and everybody's got my Skype ID. So if people do have questions, then we can answer them. So, but either way, whether you got it from Axia or got it from us, it's a fantastic course.
Yeah, and that's one thing I was saying too. You guys are very accessible, so
yeah,
it's a great thing. And David wants to know: do you provide mentoring even if I'm not using the Jigsaw platform?
No, because we want people on the platform and people using the analytics. It's just a lot easier because I can point people towards techniques. I mean, I've got a few mentoring students at the moment. It's just kind of an informal thing we do, but with them, some of them have come to me with no setup. I know we've actually, there's one setup that's working quite well at the moment with the slower markets, and that's a value trade between the Dow, the Nasdaq, and the S&P, and that's completely, well, for most people that's completely new, and it's all very much dependent on our platform. So I only mentor people that are customers of Jigsaw.
And so Jeffrey wants to know on that earnings slide that you had there for the different levels, what was the working capital being used?
This is in a prop firm. So prop firms are, well, there's a couple of things to take into account. The prop firms, they're very, very well capitalized. So some trades are capitalized to the millions. Let me just go back to it. But also they've got very, very good intraday margins, right? Because they are professional firms. So you're looking at big capitalization. The one guy that I can tell you, he was trading stocks, and he was trading a $30 million account from a boutique hedge fund. You would be amazed at some of the stuff that goes on. I mean, this guy was he was given $30 million from a boutique hedge fund, and he day traded stocks. He had 4 researchers, but he was like a bipolar, amazing trader, but bipolar, and just it was a complete bear sometimes. And one of my friends worked for him as a researcher. When my friend left, the fund gave him $100,000 to trade on the off chance some of it had rubbed off, right? And this guy had never placed a trade before in his life. So it's just some, at one end of one side of the business, there's no money available. And then at the other side of the business, you see people being so cavalier with it. But, the guy's making 160,000 a day. He had a 30 million account, but they would really ride him. If he had a few bad days, they would really ride him hard, and in the end, he got out from the deal because he just, you know for the guys in the industry, you know what it's like. It's kind of ludicrous, but that's just the way it is.
And Mike wants to know: is the trade analyze and site included with the $50 per month live trading?
It's included for everybody, basically. So all the Jigsaw customers get the analytics. And it's because the $50 for live trading is for when you've got past sim and you're trading live. And of course, we don't want to hold back the analytics for people who are trying to get to the point of trading live. So, it's anybody, whether they're trading sim or live, gets the analytics. Can't really see them here. It's a bit blurry, but there you go.
Excellent. I think we worked our way through all the questions.
All right. Well, I don't know how I did for time. Was I a bit early? Do I have to do a jig, or an Irish jig or something, or did we just get it right?
I think we're perfect. 12:30. We're right on time.
Yeah, you nailed it.
I got my dancing shoes on as well.
I'm sure you do.
Thanks.
How's the weather in Thailand?
It's better than England.
I bet it is.
It's lovely. I mean, it's hot every day, and for an Englishman, that's just I don't know. It's like a miracle. I didn't think it was even possible.
Yeah.
So, and it doesn't get dark at 4 o'clock in the afternoon as well, which is nice.
Well, you may see me soon.
I would love to. Well, look me up, and thanks for having me on, and thanks everybody for listening, and good luck with your trading.
Thank you very much. Great job.
Bye.
Okay, so I can't blow this one. David Dube is coming up next. Again, great guy, as I tried to explain before. I don't know how he can be 3 for 3, but blow that. But anyways, David has been around our forum for a long time. He's a very studied guy. Came from Morgan Stanley. He's got his own forum. Marlon, is he moving over to Mr. Top Step or?
Yeah, he's going to be using one of our rooms.
Oh, that's great.
Yeah.
So we'll be able to pop in and monitor what he's doing. But I remember back a couple months ago, I started trading the NASDAQ. And he came in the room. He said, "Yeah, Danny," he said, great job on the NASDAQ. I got off the S&P and I only trade the NASDAQ now. So you're going to get an insight from a well-known trader, guy with a background from Wall Street that is mainly trading the NASDAQ future. But anyways, my last slide here is just crude oil. There's so many markets to trade. As Tesseract has, counted out all the different markets. And to tell you the truth, I think when you're trading and you're only trading one product, that you really should, if what you use works in the S&P, it'll probably work in crude oil. It'll probably work in other markets. I know that Jigsaw, a lot of their stuff, it's not just centered on the S&P. It's on various markets. And to tell you the truth, when you're in this kind of summer slugfest in the S&P, where you've got these narrow ranges, you've got options. I mean, look at the crude oil chart today. Crude oil is ripped higher. But anyways, I don't know how many people in the. We saw when I asked where everybody's from. It looks like really it's a group of people from around the world. But, in the United States, we're pretty much used to having $2.50 gas at the pump. And now the average is getting closer to $3 to $3.50 a gallon. And what is all that about? Obviously, there's a lot of supply out there. My own opinion was, and again, crude oil got up before it traded up to 75. It popped up to 73, and when it got up there, I told people, I think on Twitter, that you should buy some puts, and that trade was right on. But then it came back down, and it traded back up. But it traded down to 63, and then it traded back up to 75, and now it's come back down again. My own feeling here is, unless Iran, tries to stop the flow of oil coming out of the Persian Gulf, which I don't think they will, that crude oil is going to remain kind of in a big trading range. But I think in the long run, crude oil is going to go back down to, the low 60s. But I will say one thing: it's a hell of a trade. It's a hell of a trade, a hell of a commodity to trade. It's always got big ranges. The volume today, I mean, I've seen days where there's huge days in crude oil where, they've got 700,000 contracts traded. Right now, it's just under 400,000. So liquidity there is very big. And again, I think that, if you're a trader, I think you've got a big menu there. One of the guys hit me up today, in fact, John Doherty, who works for us, and he said he's been trading beans, a short premium seller in the beans, and he's been doing pretty well doing it. So I guess the thing that I'm getting at here is I don't think you're just supposed to focus on one market. I think you got to open up your trading toolbox a little bit and, explore other things. Again, if it works in the S&P, it probably will work in crude oil. It'll probably work in the beans. But again, I'm not a bean trader. But anyways, our next guy up is David Dube, and I want to thank David for coming in. Really, really good guy. One of the things that we really, really pride ourselves on at Mr. Top Step is that we're not out there looking for everybody that offering a product to us. I think Marlon will tell you. We get just oodles of emails from people, saying, hey, would you like to, work with us? And we really don't. We're very selective. So the three presenters we brought in today, we've done a lot of research, a lot of background on. We know who they are. And there isn't one that we wouldn't say that their product isn't something that you should consider. But David, thanks for coming in, and looking forward to having you in the Mr. Top Step Forum. Thank you very much.
All right, thank you, Danny. I appreciate it, everybody. How's the sound for everybody? Is it clear?
You sound pretty good to me. It's going to take a couple minutes for people to get back.
Okay.
Because of that delay, but a little bit quieter than the other people, so guys can turn up their mics and maybe
I can raise it just a little bit on my end.
Okay,
perfect. Didn't want to blow out the speakers.
Perfect. You sound good.
Okay, here we go. All right, good afternoon, everybody. Again, thank you very much for taking time out in the midsummer. A lot of people are on vacation, so it's very nice to see a pretty good turnout here at this event today. So I want to thank you for attending, and again, thank you for Danny and Marlon for setting this up and having kind of a special webinar, with some specific topics here that I think is of great interest to all. And my particular topic here is what our favorite trade setups are, the PTG, Polaris Trading Group favorite trade setups. And many of you have methodologies of your own. You have specific trade setups. Many of you are well versed in various parts of market and volume profile and momentum trading and so forth. So as well as ourselves over here at Polaris Trading Group, we're very familiar in that areas. But what I wanted to do today was, in thinking about what the topics were for the webinar here, Polaris Trading Group is primarily an educator. And so, with that in mind, I wanted to present to the audience some of our specific trade setups, but look a little bit deeper into, the context of our trade setups, and not just show you some slides with some great trades. I mean, we will see those. We will see some good solid trades that we've taken in our trading room, but I wanted to present to everybody what's kind of behind the scene, because trading is so for some people they think it's mysterious, but it really isn't. And so, part of what we do at Polaris Trading Group is kind of strip down that veil of, secrecy that some people seem to want to hold close to their vest and not give out the secret sauce. As far as I'm concerned, there is no real secret sauce. All right, there's just different recipes using the same ingredients. So with that, I wanted to present to you what I have found in our work here, in our research, in our modeling of our portfolio, our trading portfolio, what our best trade setups, what we like, and that have been consistent. So I want to kind of give you a little bit of an insight to that. So the categories here is really what we call premium and discount. Now, the premium and discount that we refer to is not so much the arbitrage premium and discount, but rather when price action intraday, because we're primarily intraday traders, reaches a peak in price action where it becomes a premium to the average price. And we're looking for, in terms of a discount, when prices pull back in the context of an uptrend, when prices have gone to an extreme and they reach a level where they're at a statistical extreme to the average price, again, offering us an opportunity to enter price action at a discount or below, a fair value point. And then in terms of the trifecta, as Danny mentioned, I've traded the S&P for quite a number of years, and I still do. But with the S&P, there's kind of a term out there many people use. They call the S&P a lead sled relative to the NQ. So obviously, the FANGs are a big part of the NQ, and that's where a lot of the momentum money goes. Whereas the S&P, the larger cap stocks are involved, and it kind of slugs around there, with less momentum. At times you'll have great bursts of momentum, but most time it's kind of it's kind of a slow moving, tanker. Take a look at the NQ, and we got a very, very fast moving market. So with that, the trifecta is actually a makeup of the premium and discount. Now that the specific indicator that we use, as you can see there, it's called the CCI, Commodity Channel Index. I've used this indicator for, I don't know, better part of 20 plus years or so. And as far as I'm concerned, it can be used in sideways markets, all right, bracketed sideways range markets, as well as trending markets. So I kind of refer to it as my all-terrain vehicle in terms of an indicator. There are plenty of other indicators out there. Them, various momentum indicators. That said, am I moving that? Am I moving that? Okay. All right. So let's move on since the slides are moving. I just want to, everybody knows about the disclaimers, right? NFA compliance rule 2-29 simply basically states that past performance is not indicative of future results. So some of the slides that you'll see here are not necessarily being able to replicate and duplicate, but so that aside, let's get on to it. I want to give you a little bit of background of myself. I've been trading for 33 years. I got in the business in the early 80s, and I've worked for various investment banks, hedge funds. I'm currently an independent trader, and I also am a commodity trading advisor licensed with the NFA. Some of the companies I've worked for over the years, now defunct, Shearson Lehman Brothers, United Bank of Switzerland, and a variety of frequency hedge funds. During that period, I was a market maker, primarily in the early days listed in NASDAQ stocks, and we also traded index futures and various derivative products. Being at a large international firm gave me quite a bit of exposure to a number of different areas and trading styles. And I had also being fortunate to have a number of different mentors. So I've learned a lot of different trading styles. And being a futures independent trader is much different than being a market maker, although there are some parallels to that. And again, in my methodology and the setups that we look for, we're always looking to enter in what's called the wholesale capacity rather than chasing after price in that retail category. So we're trying to buy pullbacks. We're trying to enter at or near structural levels. We're not fade traders. We're not counter trend traders in any way. We want to stay with the major bias, all right, in the marketplace. Whether one day it's going to be bullish, the other day will be neutral or bearish. wherever the market wants to go, we want to just go along with it for the ride. All right. I'm not trying to be somebody that I'm not. I'm not trying to fade an area. I'm not trying to pick a high or pick a low. And a lot of retail style type people are always saying, well, the only way I'm going to make money is being able to, buy the low and sell the high, which is, probably, it's kind of a false assumption. And I think, and my memory serves me correct, probably over the past, during the time that I was a market maker, I may have been able to buy or sell the high maybe a handful of times as a market maker. And let alone as an independent trader, I've never been able to do it, nor do I even try to. So that's a little bit of my background. I've been doing this for about 33 years, and I love the business. I mean, it's exciting. Obviously, I've had my shares of high points and low points, just as everybody else has. So we're all kind of in that same bucket, and we're just trying to keep grinding it out every day. Traders are much different than the investment banker types and other players on Wall Street. We're in the clay. I kind of view us sometimes as rugby players. We're right in the thick of things, and that's where I want to be. I don't want to be on the outside. I want to be where the action is. Always have been since I originally saw when I visited when I was in high school. When I visited a small regional Boston Stock Exchange, and from that point on, I caught the bug, and I said that's what I want to do while I was in, when I was a senior in high school, and then went out to college, and this is what I wanted to do from that day on. And here we are. I'm 57 years old and 33 plus years in the business, and I'm as excited today as it was, when I was a teenager and in college. The markets have certainly changed, but the nature of trading, is the same. So with that, I hope you share the same excitement as I do, and view it in a great way. Just to give you a little background on what our mission is at Polaris Trading Group as an educator, and the benefits of being, using the education service that we have. It's basically four-pronged, and you can read along with me, but basically we want to improve our decision-making skills. All right, that's kind of paramount in our mission and goal, is to help you improve your decision making. Because if you have faulty decision making, you're going to be selecting the wrong, you'll be selecting the wrong side of the market, and then you'll be, selecting in turn, you'll be selecting the wrong type of trade setups, and it just kind of snowballs from there. So we want to try to help you become a better decision maker, and we have the tools that we have for that. Is very specific. We have what's called the decision matrix model, which is referred to as the OODA loop, OODA, and that stands for observation, orientation, decision, action. It's a very structured decision process. So if you're having trouble with that in your own minds and trading decisions, that certainly can be a benefit for you. A lot of us have bad habits, right? I mean, everybody has a bad habit to some degree. So we want to help you alleviate those and rid those demons of you, and help develop some new empowering trading habits. Again, it kind of coincides with those decision-making skills. As I alluded to earlier, a lot of people kind of think the market is mysterious, and a lot of people still to this day want to keep kind of their methods and secrets, just that, a secret. Well, I'm here to tell you there's no secrets, okay? And I'm going to blow that lid off that cover right now, because the secret is it's your effort, it's your time and effort that you put into this, and of course a method of some sort that has an edge. But there's really no secret to trading, okay? And then lastly, again, categorized. I want everybody here to become a more informed trader. So people categorize people as retail traders and professional traders. Okay. Well, I can tell you right now, I know a number of professional traders over my life, trading lifespan, my career, that traded a lot of money. okay, and they didn't have a clue what they were doing. So just because they were categorized or had the ability to trade a lot of money does not make them a professional trader, does not make them certainly a profitable trader. But I look at two different categories, the informed trader and the uninformed trader. Now, again, I'm not referring to inside information in any ways, but being an informed trader is, you understand the construct of the market, and you're understanding what's happening overall, and how prices and levels and volume interact with each other. So again, there's a knowledge base that's required. All right, and if you're lacking in that area, again, being part of a group such as this, would be benefit. I know all our members, benefit day to day from that. And again, being an informed trader is what we're seeking. The uninformed, as I mentioned, and that's why they say, what is it? What's the statistic out there? Approximately 95% of people lose money, and the other 5%, takes it home. All right. Well, we want to be part of that 5%. All right, so that's the kind of the goal of what we got going at Polaris. Just to give you a little bit of background there. Let's get into our topic today, though. And again, this is what I want to present to you here is actual slides from our education workshops. We have a host of content on our website that we call Wednesday workshops. So over the years, we've, on Wednesdays, we hold workshops specifically for our members and delve into a topic in detail. So before just again showing you winning trades out there, I want to show you. I will hopefully you walk away from today's webinar with a little knowledge and a little insight of how our favorite trade setups work. And again, this kind of peeling back, if you will, here's the kind of a page out of our recipe. Okay. And again, this is all information that is available out there, in the blogosphere, in the internet. But how information is just information. Somebody needs to take that information and create a cohesive, way of presenting it, and then being able to use it effectively. So as I mentioned earlier, the CCI Commodity Channel Index is what we call our CCI crossover method, also referred to as premium and discounts. And as you can see here, what our slide shows is where we're talking about where is price relative to the average price over N periods. Okay, now again, simple kind of relationships. I want to know what is the average price doing over N periods, whatever that measurement of periods you select, and then what is the current price doing relative to that? All right, very simple, right? Nothing rocket science about that, but it's as I believe Einstein said it, right, that everything is relative, so we need to compare, and that's what we're doing. If we can't compare what we're analyzing to a standard of some sort, then there's no way of properly being analyzed, to be able to make a good decision from that, comparison. So how we define a premium is simply, by definition, it indicates price strength. Okay, and conversely, a discount indicates price weakness. Okay, so that's our starting information. All right, and how we assess what we're looking for in a trade setup. All right, so as you can see here, the Commodity Channel Index can be used as a leading or coincident indicator. Again, as I mentioned earlier, it's my all-terrain vehicle. I can use it in sideways markets. I can use it in trending markets, and I don't have to change the settings. So our proprietary settings that we use are there, and nothing needs to be changed along those lines. So as a leading indicator, all right, traders like to use it as an overbought, oversold. I don't use the term overbought, oversold, although that's the conventional vernacular out there. I use extremes, right? Having worked at the investment banks, I can tell you that I don't really recall ever, when I'm in a setting where we're studying something, or even on the trading desk, that the terminology was the market is oversold or overbought. I don't remember ever hearing those terms. Rather, the terms that we used on our trading desk and in different settings was statistical extreme. All right, stat X for short. So when the market, reaches a, quote unquote, an oversold condition, for our purposes, how do you measure oversold, right? That's a very subjective way of measurement. A market's oversold, well, or it's overbought. Well, the market can stay overbought and it can stay oversold. So then those measurements, it's very subjective. Objectively, though, you can measure when prices have reached statistical extremes or statistical levels. And again, that's all mathematically based. So that's that's where I've come from. And so in terms of, oversold or overbought, we just simply refer to them as extremes. All right, so statistical extremes or stat X. All right, so this is going to be the basis of what we look for in terms of, what a premium or a discount is. Let me take another slide here, go one step further. And here I am on this slide. We're going to give you some actual trade guidelines related to that premium and discount definition and how do we use them. So again, this may seem for some, pretty straightforward and basic. At others, it may be, new, an epiphany of sorts. So in terms of a long, all right, we're looking for a discount. All right, that's what we refer to as a long. Now, didn't you just say that a discount was weakness? Yes, we want to buy a weakness, okay, but in larger degree developing strength. So what is that? What's another way of stating that? Hey, I want to buy a pullback. Okay, great. Hey, we all know we want to buy a pullback. All right. Okay, so where do we buy the pullback becomes the question. All right. How do we know a pullback has pulled back deep enough or not? All right. So everybody knows on the surface that buying a pullback is what they want to do in an uptrend, right? I mean, you've heard it around, you've seen it, everybody talks about it, but nobody really has been able to define where to buy that pullback. All right, whether it's a swing trade, whether it's a day trade, again, some of you have already methods that you're able to measure that. Okay, so in terms of measuring, I got a question here as we go along. So in terms of how do you determine the strength or weakness, we use a variety of moving averages. And also the average true range, okay, and you'll see here when we get to the charts, I'll describe a little bit of what we see on the charts as well. All right, so a lot of stuff that we use. Remember, everything that we measure, everything that I measure is in terms of statistical numbers, okay, and so a larger degree trend or larger degree strength would be an example where there are multiple moving averages moving in the same direction, and the average true range, all right, or what we have a proprietary ATR indicator that it's on the correct side. And then when prices pull back into that area, we know that the larger degree structure is bullish, and we're looking for that temporary weakness simply. All right, as related to as a discount to be able to buy. All right. Conversely, again, a short or a premium sell would be simply just the opposite. Okay. So we want to define, if it's a downtrend bias type day, we want to be selling strength. All right. So we want to be selling temporary strength. All right. And that's different than fading a move. Okay, because since the primary trend directionally is down for a short, we're looking for when the market, retraces back to some degree. Now, again, what that some degree is what the CCI is all about. The CCI can accurately give us a statistical measurement under the conditions that I've created in terms of our settings. That will offer us a lower risk entry rather than, what happens to a lot of traders, and it may have happened to some of you, and it's happened to everybody. All right, let's just put it that way. You want to buy a pullback, and so you're a little eager to get on that trend, right? Because you don't want to miss it, right? Fear of missing out. So as soon as you get one little downtick or something, okay, boom, I'm buying it. All right, only to see that, you know, downtick tick lower, okay? And you may have a 6 tick or a 2-point stop or a 3 or 4-point stop somewhere, and it still keeps pulling back, and all of a sudden, lo and behold, you know, they elect your stop, they stop you out, and that's where it turns, okay? And if you look back at that, you probably would say, yeah, I was a little early, no question. All right, so I know it's happened to all of us. All right, now the problem comes in is that it keeps happening to many. And so instead of just evaluating, you know, maybe, okay, I understand I might be too early, but how do I correct that? What corrective action, you know, can I take? What measurements can I, you know, or indicators can I use to help me better refine and fine tune, you know, my entries, okay? I always say you make money on your entries, not on your exits, okay? Because if you're in at the proper level, structure level, or zone, doesn't have to be the lowest to highest price, clearly, but if you're in the proper zone, then, you know, that's going to, and you're on the proper side of the market, that's going to be the best, you know, advantage for you, okay? And then you just let the market do its thing, and then eventually you can then work on scaling out, you know, of your position. Now, things to avoid, all right? Just as much as knowing what to do, it's probably more important knowing what not to do. So buying discounts, which is, i.e., by definition, weakness, in developing weakness, all right? That's a negative, right? We don't want to buy weakness in weakness or in developing weakness. So a discount plus larger degree weakness, right, is a no long, and vice versa. Selling strength in developing strength, okay, is a no short. So again, just converse. But again, knowing what not to do is important than knowing what to do, as knowing what to do. All right. Now I'm going to show you a couple snapshots here. We'll get into a couple snapshots, and then we'll get into the trifecta part. So I want to show you what actually a discount looks like. Okay, now if I can use the little, I don't know if I can use the parent transparency slider. Okay, here we go. Color. Okay, let's see if this works. So everybody, this works okay? Does everybody see the little circle? Okay, terrific. All right. So what you see here is this is a snapshot of the crude oil, right, CL. And what you're seeing here down below, just to give you an idea, this is our CCI indicator, Commodity Channel Index. All right, and again, it is a proprietary formulation, and again, it looks a bit smoother than most CCIs, and again, that's part of our programming. Now, what you see here is this little green zone here. Okay, that is our what we call our dynamic fair value zone. So that's kind of used as the basis of determining what is the larger degree strength or weakness that Alex asked about. All right, so let's just kind of walk through this, right? So you get you know, price found support at some price level earlier, vaulted up, okay, and then proceeded to pull back. Now, again, what I was talking about just a moment was somebody may, you know, buy them right here because you know, that first little pullback, and they're kind of a, you know, fear of missing out. So they buy a you know, a chunk here for themselves, right, in hopes that it's just going to continue, you know, rising, only again to see it kind of drift down. Well, at that point, price was just coming off, you know, the statistical high, but it still had some way to go. Now, again, how we determine, you know, kind of the zone that we want to enter in is kind of based upon what this fair value zone is showing us. So we know that's an upward drifting zone with multiple what we call the river, and you know, we want to buy somewhere as close as we can into that zone when the CCI is down near where we call the discount area. Okay, so these are all, it's all displayed on our software. And this is all live. And by the way, the snapshot shots that you see today were from actual trades in our trade room. Okay, so these were not dubbed after the fact. These were all snapshots taken and were posted on our Twitter on the day they were taken. Okay, shortly thereafter when the trade was complete. So again, larger degree strength, right? Price strength itself, but we're waiting for that somewhat of a pullback where the CCI comes down near the discount. So this gives us an idea, and what the software does. How do you clean this out? Oh, clear. Okay. So what the software does is it identifies what that discount level is, and it produces a signal bar. And there's a little, you can see this little magenta dot over here. All right. That would be the suggested entry price. It doesn't have to be, but that's the suggested entry price. Okay. And as you can see here, based upon we have an algorithm that actually does position sizing, and we also have an auto trade that built into a system as well. But this says buy 3 units at 74.21. As you can see, once it triggered, it did, and then it automatically set some limits up here to sell. Okay, and once we hit that first level, we took some profit there on that particular day. I just wanted to show also here that we also use order flow. Many of you do, all right, the footprint charts. So this kind of gives you a little zoomed in view of what that discount looked like on the order. What I like to do also, this is the setup, right? So this discount is the setup, and it gives us a suggested price. Now, what I'd like to do to get a little bit more granular is at that point, knowing that the setup is in development, I like to then zoom in on what the order flow is doing. So if I'm seeing dominant side, offer side order flow, all right, so the buyers are lifting the ask, all right, and it's a discount buy and I got the proper structure, then that gives me the green light to jump in right there at the market price, all right, and then put my subsequent stop where it needs to be, all right, and then let the market kind of unfold as it needs to, all right. So that's a discount. All right, let me see if I believe I did show premiums here. Yes, okay, so actually here's another example. In this case, both the S&P, so on the left-hand side, all right. Now the discounts, the system generates the signals automatically based upon the mathematical algorithm that we have. You can elect to manually trade them or auto trade them. I think for the S&P, most of our members, including myself, we typically will manually trade, since the S&P doesn't move that quickly, and there's usually time, to consider the setup and look at the order flow and other factors. So here's just another example where price had some strength, it pulled back. Now in this case, I'm not showing the fair value zone, but it would probably be somewhere in this zone here, and then a pullback at or near to that zone, and you can see the discount. The oscillator here on the CCI is in our discount or extreme territory. So what that means is when it's down into that area, this means anywhere in this zone, all right, is a fair place or a discounted place to take along within the context, of an upward moving directional market. So we want to buy that pullback. And again, this is the thing. The question always becomes, where do we buy that pullback? Again, somebody may have bought it up here and then decided to scale down here, and I'm going to do one more, and then I'm going to put my stop down here, and all of a sudden, what happens? Bam, I'm stopped out, and then the market reverses hard, right? How many times has that happened? Sure enough, right? We all have stories in that nature. Same thing here. Same thing here on the right hand side, which is our premium. All right. So again, downward sloping fair value zone. All right. Prices pull down, bounce back up. Again, arrow. All right. Premium. Okay. And again, I believe this one was auto traded in our system, if my memory serves me correctly. All right, so again, that's the idea, is we want to sell when there's a bounce within the context, right? And as you can see here, our oscillator is indicating that it's in a premium territory. All right, so that is the context of our premium and discounts. All right, now the next section, I believe we're going to talk about, yes, we are, is about the trifecta. So on our trifecta, let me just get rid of this. On our trifecta, and this is particularly for our NASDAQ, the NQ. So a lot of you like trading the FANG stocks and so forth. And again, the reason why we've gone over to the NQ primarily is because of the nature. There's a higher beta, a lot more volatility, and there's a lot of opportunity there. Again, you can get caught on the wrong side naturally, but we do our best, and I think pretty well, to stay on the correct side. And we're just looking to, we're very mechanical, or I like to refer to ourselves as more methodical traders, but using very strict kind of mechanical approaches. We're only looking for certain, trade setups. Okay, we're not looking to just spec areas for the sake of specing areas. We're really, we identify zones just as everybody else does for all the various methods out there between Murray math and Camarillas and volume profiles and value areas. We do all that work just as everybody else does. But once we have a zone outlined and we're interested to see how the market responds off of that zone, once we see that, then we're looking for our particular setups. Again, always wanting to stay on the correct side, of the market's action. Okay, so if everybody should know kind of what a trifecta is. If you ever played the ponies or whatever, it's a bet in which a person bets the first 1, 2, and 3 in the correct order. So the idea of the trifecta for us is that we have 3 components that are necessary for the trifecta. Now, I did mention earlier that we have an ATR indicator, the average true range, it's that we created, and we're looking for what's called a bull or a bear shift on that. So for a long, we want a bullish configuration. We want the CCI to be at an extreme, right? So a statistical extreme, and ideally, it's the first pullback following a bullish or bearish shift, right? So those are the 3 components. And we'll show you slides and what that looks like. All right, and then again, our trade guidelines that we use for this, all right, still all part of the CCI. All right, and those rules are the same that we went over earlier. So on the aggressive, we're going to take every trade set up on a pullback to the ATR level. All right, so what I've done for our members that trade this system is give them an aggressive approach and a more conservative approach. Right? Not everybody trades the same way. Not everybody has the same account size. All right, some are more timid, some are more aggressive. So there's ways of trading the same setup, but in slightly different ways. So again, we outline that for our members, and hopefully you'll take some of this away for yourselves today. So the aggressive approach would simply take every pullback to the ATR level on that first shift. The trifecta part of it is to only take the first ATR shift pullback when the CCI premium and discount signal is at an extreme level. So there's you need to have all those components, right? You need to have the ATR, you need to have the CCI at an extreme, and it needs to be the first pullback. So that's our trifecta. Now, they don't, as with all trifectas, in horse racing or, as such, they don't happen every pullback, okay? But when they do, they are very solid setups. Again, they have, as much as we look for it, components for a winning trade. And for our purposes, when we have a trifecta in the NQ, it's really a mandatory trade because you shouldn't pass up a trifecta, right? Because it has everything. Now there are other setups that have components of the trifecta, but it's not the trifecta. Okay. The conservative approach would be only to take the pullback with what we have, what's called a break point. I'm not actually showing that on the screen, but there's a confluence between the break point and a break point. What that means is when the ATR, average true range indicator, shifts from a bearish to a bullish level, it actually creates a price point, and the confluence of the break point and an ATR come together. Right now, the guideline we use for trades here, and again, this is a general guideline for everybody, but everybody is separate. The initial stop loss, we don't like to, about $200, per trade, per contract, per trade. All right, and we're looking for risk-free based upon the initial stop distance. So, for instance, if your initial stop distance, let's say, is 5 points on 2 contracts, okay, so that's $200 risk. The first exit will be plus 5 points, right? Makes sense, right? 1 R value. And then the second target would be anything in excess of 2 R once you've gotten risk-free. And again, basically, it's at trader discretion given the market momentum. Okay. All right. How often do trifectas occur? Yeah. As I mentioned, they don't occur. I don't have a statistic on how many times, because that's something that I've never actually back tested or looked at. I would say probably we get at least, maybe for the most part, when there's good volatility, we usually get a couple of them a day. All right. But you don't need that many, because again, remember, this is something that occurs when it occurs. They're powerful, but they don't occur, in every setup. All right. But that's a good question. I don't have the direct answer for you in terms of how many times. But all right. So here's what we have here in terms of some of our trifecta examples. All right. Let me change the transparency. There we go. So again, premium, as we discussed earlier, is downward sloping action. All right. Now you see these lines here, right? There's kind of a yellow line and kind of I guess an orange type line. Those are our average true range lines, our ATR lines. Okay. Now what we're looking to do is we're looking for, as price has reached a reaction low, all right, we get a retracement, just as any other premium. And the price doesn't have to always go back to the ATR level, but as long as we're on the proper side of the ATR, then that qualifies for our trade. So we did hit an extreme up here, all right, and it is in premium territory, and we have a first pullback premium. Okay, so there's our 3 components to the trifecta. And what I want to make note of, the best trade that we have been able to delineate, one of our favorite trades, regardless whether it's a trifecta or not, is the first pullback trade after a shift. Okay, and I'm going to show you the breakpoint line on the shift on the next chart here to the right. So the price is down, bounces back. Again, we want to sell strength in the context of developing weakness, and the algorithm here shows the specific entry point. Sell three units here at X price, and then there's subsequent targets, risk-free 1 R, all right, 2 R, 3 R targets, and it also gives us an auto stop level here as well. So again, the software here generates those signals automatically. You can elect to take them manually, or again, we have an auto trade that will help get you into those trades if that's what you're looking for. Over here to the right, what I want to show you here is, you see where this kind of orange line is, right? You'll see where the market kind of went from a bearish condition to a bullish condition. How do we know that? And this is the idea of the question earlier about larger degree strength. This was a bearish ATR line, and then when price traded up through that, there was enough energy to shift the line. And actually, we have dual ATRs here, so it actually shifted both ATRs. So this was, a sell side, right? And now this was the bull side, all right, of the equation. So the bullish ATRs, new price strength, okay, new direction. Now what are we looking for? We're looking for first pullback in terms of our trifecta. we're looking for an extreme condition in the CCI, all right, and the ATR, extreme, and the first pullback. So those are the three, just revisiting back what we went over. So new strength, first pullback to the ATR, or at or near to the ATR. We have an extreme condition, CCI, and we have a discount here. And again, it automatically gives us an entry, suggested entry point and position sizing if you want to use the position sizing algo. Okay, so that's our trifecta. I think I have one more. No, I don't. Okay. So that actually concludes. We wanted to make it within about a 20-minute workshop. Now, again, these are just examples. Now, actually, let me go. If we can have a little bit more time, I'm just going to quickly do a screen share. Somebody had asked me to do a screen share. All right. Let me see if I can do a screen share here. Give me one sec. Okay. Okay. So everybody should see this particular screen. All right. This is actually from yesterday's action. Okay. And this is the NQ. So again, just kind of going back to show you what that discount extreme was all about, the trifecta. So we had a shift. All right. We got a pullback. All right. So we got a shift. We got a pullback to the ATR. All right, discount, condition, extreme, right, and a discount with a suggested entry. And then you can see what happened there. Then we had a subsequent pullback, same type conditions, extreme ATR, although this is not the first pullback, this still qualified as a trifecta, and with the context of a larger degree strengthening type condition. Okay, so that's what we're looking for. We're not looking to trade every and any price level. What we're looking for here is we're looking for the CCI, right, to hit in this, in these discount or premium, type zones. Okay, and in terms of like taking an entry. Okay, so we could take an entry here off of this discount, and then in terms of taking profits. Okay, we could look for when the opposing oscillator hits up into an extreme condition, or you can take predetermined, scale outs, right, based upon a specific method that you're employing, whether it's equal risk or multiples of risk or Fibonacci's. I mean, there's multiple different ways of taking profits and out there, and kind of we leave that at the discretion of the trader. Again, the primary idea here is to, with these setups, is to get in at a level structurally with the potentially lowest risk point for potential reward naturally. And again, most of the people that I've come across over the years is finding, that entry point. Okay. And most people tend to be a little early and then they get stopped out. Okay, too quickly, and then only to see the market, and then they say, "See, I was right." Well, that's great. Being right is fantastic, but we don't want to just be right. We want to be able to make money at it. All right, and it doesn't matter about being right if you can't make money. You can't have a successful trade. All right. So in that case, this is what we're looking for. We're very mathematical oriented. It is simple to, again, it's not that difficult to use once you understand the rules. And then, of course, it's up to the individual to be able to execute. We trade these every day. I do trade them in the room. We execute them in the room, all right, for demonstration purposes. And the software generates the signals automatically for everybody. So this may be something of interest for all, okay? Let's see if there's any questions. That really concludes the core of the presentation. We do have a special offer for everybody. Let me just switch the slide here. I think how do I go back? Marlon, can you get the slides back up?
I can do that. There's also in the chat area, there's a a link there for them to
slide
click on.
presentations. Okay.
So the offer is up there.
PTG. Okay, how do I start? Here we go. Okay, not too bad. Okay, so typically, just for normally we offer a 2-week trial for $99, but what we're going to do here for a special offer for everybody attending today, come take a trial. I think Marlon had put in the links there for the trial, if I'm not mistaken, and come in and visit with us for 14 days. No obligation, no credit card needed. Come in and we'll be able to get you all set up. Okay. All right. That's if there's any questions, I don't know if did I catch.
I think I saw a couple go by. Can you hear me, David?
I can hear you.
Okay.
Yeah. Let's see.
So going down, I saw on the pullback to 73.53. Did you add, or were you out of your initial entry?
Okay, so that was on the shared. That was on the shared one from the desktop. So what we typically do is if we're in a trade already, okay, there's obviously a concept called pyramiding. So again, if you're in like an initial trade and you scale, you have what I like to do, what we like to try to do. I mean, that's kind of a goal. You don't know how the market's going to unfold, but in the perfect conditions, you start to have a core position. Hopefully, you be able to trade multiple contracts. You scale out of a portion of them, say 2/3 or some 50% or 2/3. Hold a core position, and effectively, then you can kind of just sit there with a core position. And if the market is really working well in your direction, yes, you'll have ebbs and flows in it, but as long as you're well above your initial cost point. Then when a new setup comes in, I believe the question was on the secondary pullback to 73.53 on that slide. Can you add more, or were you out on your original entry? More than likely, we either would have been out on the entire position, depending upon a scale out method, or perhaps having a small core position remaining. And then when the new setup develops, we take every individual setup individually. All right, you think about it, a new setup or the next setup, regardless of whether you have a position or not. What is that setup doing? What would be the entry? How would I manage it, etc.? What risk? How many contracts would I be willing to put on? And if you've already had a position and you've scaled out of either all of it or portion of it, you definitely can take that next trade individually. Because remember, if you have a core, hopefully it's a much lower price, because otherwise you'd be out, and then you could effectively just kind of trade that second signal in and of itself, and then still just maintain your core position. But again, a lot of that will be market dependent. But the action of the market, what's happening, etc. So it's there's no one answer, but there's some suggested ways of doing it. And again, everybody's somewhat going to be different, because somebody may just feel comfortable being all in and all out. Some people will be all in and scale out. Some people will scale in, scale out. I mean, there's, again, some different approaches there. So does the ATR factor into your fair value calculation indicator, or using both simultaneously? So the ATR indicator, all right, let me see, let me just get a slide back here. So the ATR over here, this yellow line and the magenta line, that is a totally different, separate calculation than the fair value zone. All right, the fair value zone is a compilation of just an amalgam of multiple moving averages. All right, and the idea, how we view moving averages, is that our definition of moving averages is that it's a consensus of value. Okay, so if you're using a 20-period moving average, that's whatever the last value, right, of that 20 period at that moment in time, that is the value of the average value over 20 bars. Okay, if you're using then a 50 moving average, then it represents the same. What we're looking for is the direction of that value. Is it increasing? Is it sloping up? Is it sloping down? And then what's the relationship between a faster moving average versus a slower one? And what is that doing? Are they, as you can see here in this particular slide, you can see that all the moving averages here are pretty much directed in the same way, directionally, fairly steep slope. All right. So when you get a pullback into that, what we call fair value zone, all right, and it's really just a term. It doesn't mean fair value from other, perhaps fair value, monetary fair value, or I think it's just really kind of a descriptive for us. And another way that we also describe that zone is, and I use a lot of visualizations in the education, and analogies. But think of that as a river flow. Okay, the flow of a river, the rapids, in springtime after the runoff and the melting of the snows, all right, from the mountains, right? So you have kind of a strong current, if you will, right? And then the price represents the boat, the small little boat that you're in, all right, kayak or a rubber raft or whatever it may be. And as that boat encounters the stronger force of the river, well, where do you think that boat's going to go? It's going to go in the direction and flow of the river. So that's another way of visualizing it. And I have found that particular visualization really helps members, understand that, even though price has, bounced up, all right, from a lower level, higher, and a lot of people, they start buying it right up into that river flow, and they're going to get swept away with it. For our purposes, we want to short into those areas in terms of a premium, and so we can be pushed along with the river's flow. At some point, the river flow ends up at a low basin, right? And even a rapids, it empties out into some sort of a lake, environment, and then the current there is calmer. Right, so that's when the markets can finally turn and up through past those type of fair value zones. But until then, once the flow shifted from bullish to bearish, the current is very strong at that point. So that's why it's almost imperative when we get these bounces and understanding where the new bias has shifted, and that's kind of critical for to be able to stay on the correct side of the market, because a lot of folks, this is what gets caught up. Oh, they were buying them up here, so now I'm going to defend my position. I'm going to buy more, and I'm going to show them, and all of a sudden they're on the hook. All right. Once we get a fair value zone shift, once we get ATR shifts, we are not looking. We are looking in the new direction. We are not looking in the old direction, because they're either going to be trap longs or trap shorts, and there's no way we want to get caught on that wrong side. We want to get in alignment with the new force, all right, that's developing as soon as possible. The ATR is the average true range. So how that simply is calculated is, everybody knows there's an ATR for the day, right? A 10-day average true range. Well, this is not the 10-day average true range. This is the ATR, the average true range for this particular chart, okay? Not the daily session 10-day ATR. So each of these ATRs lines are calculated at a particular factor. I believe on the S&P we use a 4 and a 6 factor of the 10-period ATR. Okay, to recognize these lines. Okay, and so again, once the price breaks that level. So you can see this little blue line up here on the premium side, okay? Well, once price broke through that level, all right, and then it created a star, that shifted the ATR from blue to magenta, okay? And that was our final break of, since we have two ATRs, that was the final ATR break. So that just, without a shadow of a doubt, we're looking for shorts, all right? And typically what you'll get, primarily with the S&P, most times you'll get a little period where the market doesn't believe it, and they're trying to defend the best way possible, all right, previous longs in this case. and then what will happen is they'll get jammed. Okay, and so what we, again, the importance of recognizing the shift is all part of this process that we use, within our trading room. Did I catch every? Let's see. Does the ATR factor? Okay, answered Alex. Raj. Okay, I got Raj's.
I think a couple new ones came in.
Okay, I don't see
there.
them. Oh,
You don't see?
Wait a minute. Oh, yeah, maybe we do. Okay. Okay, do you call out in the room trade entries and exits? What I do, I'm not a trade calling room per se. I don't sit there and call out a trade, discount here, premium there, trifecta there. I've created the program. It's called the Scanalyzer dashboard, and it actually shows all the signals. All right, so it would be like your market minder on any program that you have. It actually shows the signals, all right, and the categories, both visually and audibly. All right, and what I primarily do in the room, since I'm trading myself, all right, for my account and for customer accounts, as well as everybody in the room. So we're gathered together. We're focused on the correct side of the market. We're focused on, my goal is to keep everybody, in alignment with what's happening, what the bias is. And so once we have that, then my suggestion is let's look for premium sells or discount buys, or keep a watchful eye out on any trifectas that develop, etc. So everybody knows, what to be looking for. Okay, now that's one approach. The Scanalyzer dashboard that I'm describing, and you'll see it during your trial, displays all the signals. So in essence, the reason why I created that Scanalyzer dashboard is essentially a surrogate for me calling out trades. Okay, because I don't know if an individual is actually sitting there, right? Because we don't have cameras on each other, so I don't know if you're sitting there. So if I'm calling out a trade, buy him here, sell him there, buy him here, sell him there, I don't know if you're there. Okay, and then that can cause a whole host of issues. All right, and frankly, our members don't really want trades called. For people that want trades called per se directly, what that says to me personally is that they don't really want to do the work. They just want somebody to tell them what to do, and you're not really going to get too far, that way. What I like to encourage is learn the setups, work with them, practice with them. The software there and the direction and the guidance that I give throughout the day should be ample enough to keep you potentially in, taking good trades, not fading the market. Like as I'm watching the market right now, it's down, we're down off the highs and we're at near lows of the session. How many people out there do you think right now are long and are struggling? Well, I can assure you that nobody in our trading room and our membership is long at this point. I can, without a shadow of a doubt, I don't worry about anybody being long. So my goal is to help you stay on the correct side of the market, number one, stay out of harm's way. If I can help you do that, then you're going to be in a position to learn and then look for what the good trades are, good potential trades are to get, on it. Okay. Let's see, that was Larry's. What's your main website link and what is the, okay, so it's, let me just type it in, Polaris, tradinggroup.com. Oh, let me just put up a slide here, by the way. Let's do that. How come they're white? Oh, here we go. Okay, so as I mentioned, we have a 14-day trial. All right, so feel free to come on in, take that free trial from the link that if Marlon can post that again for those that missed it, that would be great. And then here is the website. It's PolarisTradingGroup.com. All right, you can reach out to me at David at PolarisTradingGroup.com if you have any further questions beyond here. I'm trying to sign up. It's being asked for an access code. What would I enter? Let's see.
Yeah, I just it's PTG for Polaris
Yeah.
Trading Group, MTS, Mr. Top Step. So PTG MTS. I just posted in the room here.
Oh, okay. Oh, that's different. That's right. We have a, yeah, actually what we're doing is I have my own, I've always had my own room, platform, trading platform, and webinar room. What we're doing is Marlon and Danny have provided a room through the Mr. Top Step platform site, the tradechat.me or something like that. We're going to have our own room linked with Mr. Top Step. So if you have any questions about accessing that room, direct your questions to Marlon, and we'll get that set up definitely by tomorrow. So we'll be ready to go tomorrow morning, and we'll just we're going to test that a little bit later on today, and so everybody can start their trial tomorrow. All right. Jeff asks, are the charts available only in NT or Sierra chart? We don't, if we don't use any of the platforms, signals from Scanalyze. Okay, so the two primary platforms we do use a Sierra chart in our trading room, and then we support NinjaTrader 7 for our indicators. Okay. If you don't have those platforms and you're wishing some sort of a trial at some point, we can certainly get that to you. All right, that's not an issue. If you have another platform like I don't know, Thinkorswim or IB or something like that, TradeStation, whatever, and you can still watch. Being a member, you can still observe our Scanalyzer dashboard. Okay. If you have the software, then you'll have it on your own desktop. But you can certainly watch the Scanalyzer dashboard. The only issue about disclaimer I would say in terms of watching our software in the room is that I would not use it for trading, because simply the latency issues, or sometimes the internet freezes, things like that can cause problems. But you can certainly observe what the signals are without problem whatsoever. Just as you're visiting, if you decide you wanted to join up for further education, so that's not a problem. Did I catch all? Oh, wait a minute. Yeah, I think I caught all the questions. Did I miss something? No, I think we're caught up. Unless I missed something. Anybody else have any questions, or did I miss a question? I apologize if I did miss.
Good stuff. Last chance, guys.
Oh, Alan asks. Al asks. I'm sorry. Your main website. So you see that up on the screen there, PolarisTradingGroup.com. And what is the cost post trial? So the cost of the room is if you decide to join up as a full member, which gives you all the benefits of getting all the educational material, all right, being in the trading room on a day-to-day basis throughout the month. We also get a copy of the daily trade strategy, which is posted to the MTS site each morning, so you have access to that via the website as well. So there's a lot more information. It's our daily trade strategies, our simple plan, what we're looking for, what we're expecting for the day, what key levels to be looking out for. So post trial, post your 14 days, and by the way, somebody had asked earlier in the previous presentation if if you're on vacation over the next week or so and you want to join up, is the trial still good? Absolutely. Okay, just just connect with Marlon on that, and we'll get you in for the trial. Not a problem whatsoever. In terms of the cost thereafter, it's $200 a month, but we typically would like you to join up for 3 months at a time quarterly, because that allows you to have full access to the members area and for ongoing education and so forth. So it's basically $200 a month after that. All right, I think that was the question that I had missed. All right. So I think that concludes my portion. I probably went over the 30-minute time period, but again, I want to thank everybody for taking the time out. And again, thank you to Danny and Marlon for the presentation.
Thank you, David.
Yeah, thank you, David.
We're 2 hours and 52 minutes into this. Well, we did start 10 minutes early, so about 2 hours, 45 minutes. Not too bad.
No.
Not too bad for 3 presenters. So good job, everybody.
David, sorry about saying you were an ex-Morgan Stanley guy. I knew you were from UBS. I got Alzheimer's or something. But there is another trader that we know that was from Morgan Stanley, so I was thinking, I don't know.
Yeah, that's okay. Not a problem. It's all good.
I remember talking about Lehman Brothers with you too. So, anyways, well, great job today, and thank you so much. Looking forward to working with you.
Thank you, everybody. Have a good rest of your day in trading.
Okay, so you know what, everybody, this is going to preclude the webinar. We've, like Marlon said, we've gone on for almost 3 hours, which is quite a bit of time. I hope you guys gain a lot of insight on what the presenters were talking about, and kind of a little bit more about Mr. Topstep. Like I said, we're pretty selective about who we bring in, and we do a lot of background. We really kind of check them out before we agree to take on their products or sell their products. And like I said, if something out there is for free and it's on Twitter, don't believe it. You got to have to find the right products, be around the right people, and we think we brought in the right people today. So thank you very much, Marlon. I hope everybody had a good webinar, and hope to see you soon.
Yeah, and you guys will be getting the links to the replays and stuff. Hopefully that part of the technology worked today. So,
right.
Everybody have a good day. Hope to see you guys in one of the rooms. Join us.
Good job, Marlon.